All right, everybody, welcome back to another video here on the Dividend Doggo Show on YouTube, and I'm bringing you in for the weekly portfolio review. This has been a pretty wild week, so let's go ahead and dive straight into it. You can see the portfolio is sitting at $726,000 and $30.06. So let's break that down. What happened this week? Overall, this week was a very red week. Obviously, if you've seen any news at all, it's been very, very negative news. Brink of war, countries being invaded. I don't want to dwell on it too much, but you gotta have a stomach to play in the stock market and stay invested. But overall, I want to bring you in. This is how we ended the week. We ended the week $6,117 up. We earned $13.88 in dividends, and that's pretty amazing considering what's been going on. Now, there has been quite a bit of the shake up here with the stocks overall. You can see we have some in the red, some in the green for categories. So let's just go in and take a look real quick at each one. So let's break down and look at the healthcare sector so far, which is my largest sector because of the growth of AbbVie over the past year. Now, AbbVie was up 3.8% on the week, and it was up 3% almost on the day alone. So a lot of that jump was just today in trading, and Johnson & Johnson was up almost 5% on the day, which is absolutely wild to me that in one day it had a total gain of almost $5,000, which is pretty crazy. So let's go ahead and dive out here and take a look at consumer. Consumer was down for the week overall. Now, a large chunk of that was based off of the back of Home Depot for this pie. Home Depot was down 8.64% off of guidance being lower. Not that their call was really bad, just that their forward guidance was basically slated to be about average and wouldn't have as much growth for 2022. Overall, if you were looking to start a position in Home Depot and you were buying this week, you're obviously getting a pretty good discount on a very high quality company that just gave us a phenomenal dividend raise. And, I think that their growth may slow down a little bit. Prices and inflation are going up. People have to be a little bit more selective about what they're doing, but they're still going to spend that money. They're still going to do home repair. They're still going to do projects. They're still going to do upgrades on houses. That's just going to continue on. And I think that if you're buying it, if it's on your radar, go for it. It's an absolutely phenomenal stock. I'm happy to have the position that I do in the company. And I did go ahead and purchase a little bit this week. I'm going to bring you into the buys for the week real quick. It was Costco and Home Depot. Costco paid out its dividend, and I went ahead and attempted to buy another share, and I bought a little bit of Home Depot for this week. Now, these stocks aren't cheap. They're not at discount. I just want these stocks in a higher position, and when their dividend pays out, I want to try to add a share to each one whenever I can when their dividends roll in. So with Home Depot being a little bit at a discount this week, it was one that I wanted to add to. So I went ahead and made a buy this afternoon. Now, going into utilities, VST was up a bit off of the week. I'm going to dive in and take a look at that. Mostly this was off of just Friday. Friday, both Duke and VST had phenomenal days. And VST had its earnings call this morning, which was really, really early. I will go over that right at the end of the video for the day. So finance was down for the week. This is across the board. Almost everything except for Ally was red. And, I expect finances to be a little bit in the ups and downs. If you look at the one day though, on Friday, they closed out very, very strong. So they were down all week, and they took a pretty massive dive. It was down 4,000 and change on the week on Thursday, and then Friday it picked right back up. So it's absolutely pretty wild how you can see, world circumstances directly affecting these different positions with these companies. Overall, Como Money was pretty much average for the week. It didn't really go up, didn't really go down that much. Berkshire Hathaway did come up a little bit, which is awesome. I love seeing that. I would like to get a few more shares of that, but it is expensive. TechPie was down just a little bit this week. Microsoft was up, but Apple was down. So overall, that was almost even. In industrials, we have some big gains for, the two that I have, Lockheed Martin and Raytheon, both defense sector industrials that basically, they make rocket defense systems, all kinds of different parts, plane parts, all kinds of different products. So off the news of countries going to war, those are two stocks that you definitely want to keep in your portfolio for a while, because those defense contracts will come out more and more. Cat was down a little bit. They have a lot of construction and building across the world, so I kind of expected them to be down a little bit. Overall, the monthly dividend stocks were up. That's 1.69% for the week. Overall, that's pretty good. I think this is mainly off the back of Microsoft, but that's pretty amazing. And then the owner's rewards pie, this is just a pie that has a bunch of different companies that I get a discount with the credit card through M1 Finance for holding some of these. Some of them are up to 10%, like Chewy, Netflix, GameStop, so on and so forth. So I don't really watch or track this all that much, but it is interesting to see that it went down just a little bit for the week. So overall, nothing really changes for me, whether the market is red or green. I'm going to continue to try to buy the stocks that I want to try to hold for a long period of time, and just going to continue to keep on investing. Now, that brings me to, I wanted to talk briefly, because I know several of my subscribers do have positions with VST. I'm sure that they saw the news. However, they did have their presentation today, so I'm going to go ahead and engage in that really quickly. This was the full year results for Vistra, which is an energy provider for a large portion of the United States, including Texas. They do battery storage in California. They do energy generation for Illinois and several other states. So overall, residential customer count increased pretty significantly over 2021, and then this was due to Uri knocking out several of the energy providers that literally went bankrupt. Vistra was able to take over some of their customer count in the Texas residential sector. ERCOT basically kind of governs the electrical grid for Texas, since it's kind of like its own thing, which is kind of silly. It's a little bit insane. But overall, we are seeing pretty significant returns of capital. We knew that they had their share buyback announcements from last year. So let's just go ahead and take a look at that. Now, the stats still look really rough for the year because Winter Storm Uri occurred. They lost over $1 billion there. They chose to accept that and pay the bills instead of fronting a lot of that to their customers for residential use. But they did front some to their business users, which I found very interesting. They basically did it on a multi-year program to regulate out the amount of the bills so that it would be easier for businesses to take, which is very interesting that they did that to me. The return of capital for this year was absolutely incredible considering the circumstances. They did buy back 7% of the shares that were outstanding for the company in the third quarter 2021, which is from third quarter to fourth quarter. So that's absolutely amazing. They did preferred share offering, and they distributed dividends of $290 million in 2021. And they're expected to return $7.5 billion in 5 years. Now, this is a company with right around, I believe it's $10 billion market cap. So this type of return is absolutely incredible. I do expect that over the course of 2022 and 2023, they'll continue raising that dividend. I believe the last goal set was to 76 cents. Which where they're at right now today is, I believe, right at 78 cents. So 2023 will likely see another 2 cent per quarter dividend raise to get us to that 70 cent mark for 2023. That's pretty amazing considering that, it's like a 12%, it's just above 12% dividend growth per year for the next 2 years, which is amazing. Right now, their yield is right around 3%. So having that go up with a growth of that rate, if they can continue that growth over the course of 5 years, which I think they can, especially if they're reducing the overall shares in the pool, they should be able to keep that going for the next 5 years. And I can see this plan coming together and working. And I absolutely love when a company gives guidance on what their ability to return capital to the shareholders is. Oftentimes with companies, you don't always get a clear picture of how you're going to get money back, how they're going to return value to you, whether that's increasing your stake in the company by reducing the overall share pool or paying you out an increased dividend. There has to be a method for them to give you that value back. And you can see that here with this company. And I absolutely love that. Now, there's a lot of debt with this company. It's right around $10 billion, I believe, and their plan to reduce debt over the course of the next year is pretty wild. If they can continue on the path that they are going, that's going to absolutely be amazing. The guidance is a little bit lower compared to 2020. However, you see that 2021 guidance was really hurt by the $1 billion costs of Winter Storm Uri, and the fact that they're back up over the $3 billion mark for this year, and this includes still some of the losses from that. So that leads me to believe that they're going to be in a very, very strong point. There was a $2 billion cost overall from Winter Storm Uri total, which is part of what drove the stock down so much. But this is what I love to see. This capital allocation plan really drives me to want to continue to be a shareholder of this company. Now, they executed $764 million of the authorized $2 billion share repurchase program before February 22nd of 2022. That means that they've got $1.236 billion worth of capital to do share repurchasing. That's almost double what they did last year for 2021. And if they continue to buy at that rate, that is going to be absolutely incredible for shareholders, because you're getting so much more equity for each of your shares. They're going to be such a higher percentage of the company when you're talking about buying that much back, because that's just under 14% of the entire company's outstanding shares that they're slated to do in repurchases. Now, is it a value to go and buy it in the $20 range? I was buying it at a mix of price points, but when I went really ham was in the 18-17 range. It did go as low as 15 and change, like 15.60. That would have been a phenomenal entry point for this stock. But 22 range, which is about where it's at today, is not that bad. And if you consider what your growth is going to be on both the dividend and the expectation that they're going to do these share repurchases, and that those preferred shares will eventually fade off, that they did the $1 billion in sales for, That's going to be absolutely amazing over time. The board approved that 17-cent per share starting for March 31st, which is the first dividend payment of 2022. And that expected cost is going to be just shy of $300 million. Now, this is going to actually decrease the expected annual dividend total cost because they're reducing the overall share output. Now, they do still have to pay those preferred shares, so it won't decrease too much, but it does still give them some access and wiggle room to continue raising the dividend if they want to maintain that balance of paying out that portion of money while reducing debt on the company's balance sheet. So they reduced debt by $625 million in the fourth quarter, and they're on track to reduce debt by the end of 2022 by $1.5 billion. That is 15% of the total debt balance sheet the company has. Now, this is exclusive of any other zero project. What that is they're reducing their carbon footprint by reducing the overall coal generation for power and going over to more sustainable methods such as gas, solar, wind, things of that nature. This is absolutely phenomenal. They raised preferred shares $1 billion to continue growing that segment of the business as well and basically accelerate it. That's absolutely amazing. As we go through, we get some pictures of these new storage facilities for power that they're doing. Brightside and Emerald Grove, this was the first time I'd actually seen the pictures of these panels in the field. This is absolutely amazing because it's generating such that's a pretty significant chunk of power, and they have a large bit of room that they can expand this in Texas and enhance the ERCOT grid overall by making sure that they've got these massive storage facilities for power to create a buffer between the hiccups of even winter storm weather and stuff like that. For the future. So I found this really interesting to see these in the presentation. And Moss Landing is the California facility that's the largest of its type in the world. And they're bringing on an additional phase to add more to it, which is absolutely amazing. So they are working hard to get to zero emission. And this is really something that I'm personally passionate about, is that getting these companies and power generation away from being so dependent on fossil fuels. And it's going to be absolutely amazing to see this company grow to that, net zero carbon generation 2026. That's amazing. Getting rid of all of these and retiring these out over the next few decades is going to be awesome to see this change. Now, Curtis Morgan was awarded, I went and looked at the shares that this man got for being the CEO of this company, and it's staggering. I love the fact that I've got 6,000 shares. This man got 100,000 shares granted for his compensation, which is absolutely incredible. He is very much incentivized to make sure that that dividend keeps growing, because that's his retirement nest egg right there. I mean, this man will be able to easily retire off of just his shares of Vistra going forward. And they've raised, I guess, a lot of the heads of the company are getting more shares of stock versus raw core compensation. So a large portion of the insiders on this company were both not only buying some shares, but they're also being granted that as part of their compensation packet, which is absolutely incredible. And you want your staff and your leadership to have equity in the company and want to continue to build up the company so that they're not only is their stock worth more, their dividends are worth significantly more. So that said, overall, I expect to see the EBITDA will keep growing some, and once they get rid of a lot of the debt, you can see here this debt balance sheet. They've got just over $10 $10 billion worth of debt total, but a lot of this is coming off the balance sheet before 2030. So I'm going to be really curious to see where this company goes over the next 8 years or so. If they can wipe out a lot of the debt that they have, that's going to be pretty amazing overall. And if they do end up being able to wipe out 1.5 billion this year, that's going to be staggering. You look at these like 5.5 and 5% secured loans these are unsecured on this side. I'd love to see this all get completely wiped out within the next 3 or 4 years and get it on track beforehand, before it actually gets to those dates where it, would be coming completely due. I don't really like seeing a lot of the debt on the balance sheet for a company like this when they have good free cash flow in normal years. Obviously, 2021 was not a normal year at all. We did see a pretty large, hefty growth in the business portion for the retail volume in all their markets across the board, which is pretty amazing to see that level. We did decrease a little bit with residential. They were basically depreciating several of the large production facilities that were coal-based. So we will see some shifts away in the residential sectors, which is kind of interesting. But then you also get a breakdown of their generation metrics and seeing where they're generating total power, capacity outputs, commercial availability, things like that. Now, overall, I think that there's a really interesting balance. I'm going to be really curious to see how much their natural gas sector goes up in prices and things like that. Because when we look at the market pricing, the projected for 2023 is actually down, I found a lot of this interesting, and I need to do a little bit more research on why they think the costs will be going down for, Indiana and, all these different areas across the country. I would have thought that a lot of these costs would have been increasing on this for market pricing. I'm not sure how far ahead they actually have to do their deals for their prices to continue generating and providing the power for these parts of the country. I just find that very, very interesting overall, just looking at the costs for 2022, but then seeing, a decrease in cost for the Texas ERCOT North Hub being almost $5 in difference base, which is pretty wild to me. So overall, very, very interesting stuff. I'm very, very happy overall with the performance and the path that leadership has chosen to go for this company. If you're not invested, I probably just bored you for 12, 13 minutes. But for all my Vistra people that are still holding their shares, I know several of you bought off of, several people in Discord buying. But overall, I just wanted to say, cheers to 2022 for VST, because it's going to be amazing if they can pull off everything. So thank you very much for watching this week. Stay vigilant with your stocks. Don't sell things just because you get scared and the market goes down a few percent here and there. Even if it goes down 10, 20%, that's when you should be buying, not selling. Keep things consistent and always be buying. Thank you very much for watching again. We crossed over the 1900 subs mark on YouTube. I absolutely appreciate every single one of you. I am so looking forward to hitting that 2000 sub mark. Thank you very much again for watching, and have the best weekend you possibly can.